the honor to have with us this afternoon Kathryn Rooney Vera. She is the Head of Research, Chief Investment and Strategies, Managing Director of Boutique LLC. And she is a renowned public speaker. And you've seen her probably in Bloomberg TV and in some other programs speaking about the markets. And I'm sure that she's going to enlighten us this afternoon with her expertise in the Latin American markets.
Thank you, everyone. It's such a pleasure to be here today, and I appreciate the applause. That's beautiful. I'll pretend it was all for me. Thank you very, very much. No, it's my pleasure to be here, and I'd like this to be interactive. So, as I'm going through my presentation and giving my somewhat controversial view on the world and markets, I invite comments. I invite questions, and I invite a discussion as well. So, I think I have 40 minutes. Is that correct, Jane?
Yes.
Okay.
And then we have
So just give me a little high sign when I need to start rapping. Please, thank you. So this is basically going to look at, I'm a market economist, I come from Bear Stearns. Look at the markets from my lens as a market economist. So where are we in the stage of the economic cycle? Both in the US, at a global level, and how that impacts Latin America. I'm going to give you that macro perspective very quickly, then delve immediately into Latin America. From there, I'll end with where I think we can make money, which is the key question. We all want to make money, for us and for our clients. So let's get into it. US, recession risk. Last year, this was all the talk. Everybody was talking about recession. Not just if there would be a recession, but what month of 2020 it was going to fall in. So it was always fun to go on TV programs and get asked this loaded question of, okay, what probability do you assign? 50, 60, 80% probability over the next 15 to 24 months. So what we said back then, and I hold on to now, is that the risk of US recession in 2020 is very, very low. In fact, I don't think that we're even close to it yet. That's my view. And I try to give empirical evidence as to why. Remember that the US economy, starting with the US very quickly, 70% attached to the consumer. So while we have the US consumer and small business confidence at these levels, even despite this tick down, even despite the recent tick down in, look here, small business optimism, we had a recent tick down, we're still at levels not seen for decades. Consumer confidence, we saw a small tick down, well, more than small, I guess, but it since has recovered. So until I see consumer confidence take a downward trajectory on a sustained basis rather than 1 month, right? 1 point does not a trend make, so it has to be 2 to 3. Once I see consumer confidence fall off a cliff, then I'm gonna say, you know what? Recession is more of a near-term worry. There are economic cycles, recession is inevitable. It's going to happen. But we have a myriad of indicators. I'd like to run you through these columns. I think they're pretty interesting. Months to the recession after the first inversion. It's not immediate. This is one of, I as an economist here locally, I have 15 indicators that I really care about. I mean, there's a lot, right? I have 15 that I really care about. This is one of the ones that is negative. I have about 3 to 4 that are giving me yellow flags, yellow to red. The rest are not. But this is one. If the inverted yield curve was still the same in terms of its integrity now than it was before the Fed started manipulating the curve, which you can tell I don't think that's the case, you would still have 14 to 24 months before that recession occurs. So if a Trump re-election, I thought that was astronomically high. So my answer to that would be yes. And I think it's overpriced. I think the risk is
So the market is pricing a Trump re-election. Why do you think that Warren would be such a strong impact in the market?
Because Trump is priced into re-election.
Right, so why the Democrat nominee would make such a difference if Trump is being...
Oh, I get what you're saying. Because she's not currently priced in right now. And I think that with the impeachment weakening and a more potent opponent, such as she, I think she presents a more formidable force than would someone else. And I don't discard her beating Trump in November, would be my view. Plus, I think the market is too complacent with regard to political risk. I personally don't think he would win re-election, but to give you that number, the market seems to think it's a good chance. There's a very good chance. So let's move on to a fixed income though. The biggest risk for me is not impeachment, it's not Trump re-election, it's not even Elizabeth Warren, really. The biggest risk right now is negative yields in debt. And I'll give you, since this is a closed door meeting, I had a meeting with Jamie Dimon actually in the IMF meetings. Do you know what he said? Before I said it, I was so happy, I felt validated. He said the biggest risk right now is negative yields in debt. And I said, oh my God, that's what I've been telling everybody. So I feel like I'm in good company here. Because this is literally a guy who is moving policy making. Look at what he did with the repo markets. Got on the phone with Mnuchin, got that tied down. The biggest risk in the markets right now is NIRP, negative interest rate policy. From my context in DC, when I was there in the IMF meetings, it's supposedly never going to happen in the United States. Yeah, right. It could happen in the United States. Negative interest rate policy, of course, meaning that the Fed goes all the way to zero, but then takes it negative. You will all know, of course, that Europe is at negative 0.5 deposit rate. So they're charging banks. Banks have to put their reserves in the central bank, and they pay the central bank to keep those reserves. So it's a tax on banks in Europe. So the biggest risk, in my view, is nothing other than negative yields in debt. This chart is outdated. I need to get a new one because currently we're at $18 trillion in negative yielding debt. This is not a majority of current debt yet, but it is a significant portion. It's about a third of all outstanding government debt right now, if not more. What are the risks? What are the bubbles to negative interest rate? Did anyone here participate in the century bond on Argentina? Don't be embarrassed. Don't be embarrassed. Because we all did.
Well,
Because you know how I know we all did? Because it was 12 times oversubscribed, 10 times oversubscribed. So we all did. Don't feel bad about it. We're all hurting from Argentina. But Argentina was 12 times oversubscribed. How many times has Argentina defaulted over the past 100 years? Who said it? Right. 8 times. 8 times. But a century bond, which has a maturity of 100 years, was oversubscribed by 12 to 15 times. That's a result of negative interest rate policy. We don't think about it, but it is. It is. Probably familiar with the other piece of news that struck a chord in my head and I can't forget about it, which is UBS charging their high net worth families and individuals to park their own money in cash. They're being forced out the risk curve. They're being forced out the duration curve. What did we learn from 2008? When you manipulate the markets and force stakeholders to assume risk that they otherwise should not, it all unravels. It puts me in mind of Freddie Mae and Fannie Mae and government incentives in 2008 to promote homeownership. What happened when the market unraveled? Massive defaults, okay? When, not if, when inflation comes back, I'm not gonna tell you when that is, but it will come back. All of this has to come home to roost. Because when inflation comes back, we're not talking about negative interest rates anymore. We're not even talking about zero interest rates anymore. We're talking about central banks that have to catch up and send rates much higher when inflation. I think there's a really big problem right now in the markets, and that is this misperception that inflation is dead and buried. That inflation is a phenomenon that no longer is relevant in our markets and in our economies. I'll agree, I'll be the first to agree that inflation is very muted. and will likely be so for some time. But to say that inflation is not a monetary phenomenon, I think is to home, because a lot of people, including my clients, have bought the maximum duration possible just to get the yields for their clients, understandably. I worked at MetLife just like George. We both worked together at MetLife. I get it. Imagine those PMs now. You have assets and liabilities you have to match. And you have life insurance policies that go out 30 to 50 years. Not 30 years. Where do you get the yield now? The German curve is completely negative. The entire German yield curve is negative. We're not talking about an inverted yield curve. We're talking about inverted and completely negative. Oh, and by the way, in recession. So let's think about it. This is my view, but I think intuitively, the monetary exercise, an experiment that was attempted, didn't work. So, or we could say, if you don't like that, which I think is the right answer, you could say it had mixed results. Or you could say it was somewhat disappointing. Well, let's face the facts. Europe, I took it out, I'm trying to keep it shorter because I know you guys only care about LATAM. Europe took their balance sheet up far more than the Fed now and the DOJ have, and they have a deposit rate that's at negative 0.5%. Okay? And what did they do in the last meeting? Double down on the bet. Double down on the bet. So that, I think it's a big problem. One of the other bubbles that I saw back here, which really concerned me, we've since flipped back, but if you remember from your economics classes, standard deviations, well, the 10-year treasury, when it broke down to record lows, 1.4 and change, was on the cusp. This was freaking me out. It was on the cusp of breaking the bottom rung of the third standard deviation, which statistically, literally almost never happens. Okay? And it happens 2% of the time in history, by definition, for 3 standard deviations. It was going to break the bottom of the floor here. Since it's come back, because we saw 10-year treasury yields go from 140 to 180 and change. But that's also part of I would say, the non-desired consequences of negative interest rate policy. European bonds. Everybody except, for some reason, Italy. We all know the reason. We all know the reason. But everybody else is a negative yielding on the 10-year space. So their benchmark 10-year bonds, negative. Italy, of course, is a basket case, so it still requires a premium for anybody to hold a paper. Okay. So this is a summary of my points. I like to be very clear with what I'm saying here. My view is that activist and interventionist central banks are actually creating distortions and incentives which at some point have to adjust. They have to adjust. I'm a very more fundamental economist. So what I say, instead of monetary policy, which is economically debatable whether or not it creates growth. So dropping rates doesn't really create growth in itself. What it does is it incites credit expansion. So it incites consumption. So when you drop the benchmark interest rate, as the Fed has done, as the ECB has done, it creates desire for credit because you can take out a very low rate, right? You can refinance your mortgage. So instead of paying 7, you refi and you go to 3.5. Fantastic! I have more cash in my pocket. Spend it. My concern has been consumption in this country, ladies and gentlemen, if you've been watching the news, is growing at a remarkable clip. Second quarter consumption, 4.7%. Third quarter consumption, we all thought, including me, we all thought it was going to come much slower. It beat expectations, about 2.9% if I'm not mistaken. Certainly a deceleration. but consumption is the major arm of the economy. So if we're cutting rates, what exactly are we trying to get done here? It's investment that took away from growth. It's not consumption. Consumption has been adding points to growth. So I guess my point here is that dropping the interest rate is not the panacea. It's not the solution to everything, and it will not achieve all of the goals that we're looking for, which is sustained economic growth, inflation of 2%, and unemployment. Oh, I forgot, we already have those two, right? So we already have full employment, and we have inflation at 2%, just a little under. So if you are what's the word? The Constitution guys, they had the strict readers.
Strict constructionist?
Yes, thank you. So,
Yes.
so if you're a strict reader of the double mandate, or a strict reader of the Constitution, you say, guys, you have dual mandate. Say, we did it, senores, I'm going home. I have full employment, I've got 2% inflation, I'm good. And so are you. No, we have a Fed that's cutting. I think it was great that she published on the Federal Reserve website. She said, the natural rate nowadays is 1%. 1%. So my point is that Taylor rule is not that it doesn't work anymore. It's that structurally, we do have lower inflation. We do have more inflation. Where does that come from? Robotization, automation, and of course, they talk a lot about the demographics and the baby boomers. But I would say that it has far more to do with Amazon basically consuming industries, right? You go to CVS, how many of you see human beings at the cashier at CVS or at Lowe's or at Home Depot or at Target? Who doesn't love going to Target? Target's like the best place. But you go there, there's no cashiers there anymore. So these are things that are keeping a lid on wages and inflation. Doesn't mean it's never going to come back. Doesn't mean it's not going to accelerate. It means it's going to take yet some time. And what the gentleman's point is that, hey, everyone else is doing it. We have to maintain competitiveness. And I agree with you, I get that point. However, at what cost? Because think about it, if we were to cut rates to 0 or negative to be competitive with the competition, which is Europe, which effectively really isn't competition because they're not growing, they have no inflation, there's no jobs there. So, but I get your point. If we were to do that, in a point of the economic cycle when it wasn't merited, where does that leave us when it is necessary, right? Where does that leave us when we do get a recession? So I quibble with that argument. I understand that that's the president's argument, and that's a lot of people who have said that. The fact is that we are not in a recession. The US is growing at, what was the last number, 2.6? 2.6% annualized, pretty good. And you know what, that's above potential, and it's above trend. It's above both. So really it doesn't require it, and I fear that that would also infringe on the Federal Reserve's credibility. Not that there's that much left, but I appreciate that Jerome Powell is trying to claw back some credibility there with regard to his mandate, which is inflation and full employment. So if we were to cede to presidential pressure, or if we were to follow the European train, I think that there would be a lot of undesired consequences, personally. But people ask me this a lot. Is the Fed yielding to the president when they cut? And I would respond, and I have responded, that no, they're not yielding to the president. I think they're yielding to the markets. There's never been a time, go look at this up if you want to corroborate it, but there's never been a time when the Fed hasn't cut, when Fed funds futures markets are discounting above with above 60% probability of said cut. They've never failed to deliver it, ever. They will always cut. So they say they're not going to cut again. I don't know. I think if you get another squabble or another blow up with China, or if you get a market tanking because Warren wins, I'll bet your bottom dollar you get another cut. So China's not a fundamental part of the American economy. This is the reason why I said go long back in December of last year, and why we got it right. So China is not a fundamental part of the US economy. Trade is not a fundamental part of the US economy. But we know that it could impact inflation.
If you believe that China is not fundamental for the American economy, why do you think President Trump was so eager to point to China as the major enemy right now?
Because he's talking about fairer terms of trade. So fairer terms of trade. So fairer trade, not free trade, fair trade. That's more political. I mean, I'm an economist. That's political. I think it's part of winning the presidency. He won on that. I think the president won on immigration and on improving trade terms of trade.
Sorry, what's in your definition of consumption?
Great question. So I'm gonna go here, I'm gonna go to this table. So so I look at core PCE. My goal here with this table was to see how much an impact on core PCE tariffs on China would be. Why do I care about core PCE? Because the Fed does. That's why I care. I think that's good enough reason.
We include services?
Correct. So what is core PCE? Core PCE is the basket of consumed, not just goods, but services. So we're not talking about how many widgets are made in China. We're talking about something that I think was more relevant. How much of everything we consume that's in the core PCE inflation basket comes from China? So of course, if you think about that, core PCE and the amount of services that we consume in this country, you may not be so surprised to see the percentage of total consumption of goods and services from imports is only 17%. Okay, 17%. Of which, percentage of total imports, 20% come from China, 13% come from Mexico, 35% from both. I put Mexico and China, of course, in here because that's who we were picking the fights with. Okay? So, what this tells, simple math. Say you put a 25% tariff on 100% of Chinese imports to the United States. 100%, not 40% like we have now. 100 for 1 year. For 1 year. You get an additive number, so 0.9 points added to core PCE. So core PCE right now is at 1.8, right? 1.8? Or 1.7, it's at 1.7. So let's round it up. So go to 1, so you'd be at 2.726 over 1 year. This is ceteris paribus, my friends. This is everything else equal, which we know it's not. This doesn't even consider exchange rate fluctuations. So when the dollar rises, it favors the US. It doesn't consider import substitution. It doesn't consider guys leaving China going to Mexico, which has happened. Thank you, GoPro. Okay, this, because it's not based on one sector, it's based on 4. So the growth is widespread, evenly dispersed, and firing on all 4 cylinders. So that's probably my favorite in terms of economic performance. Colombia's picking up. I would say of all of these, you can see Colombia kind of doing the best. Second quarter numbers came out really good in Colombia, 5% annualized, very, very good, and led by consumption and private investment. So that I like to see. Brazil doing well in, I guess, comparatively. Mexico, I had to downwardly revise my economic forecast. I'm now slightly above 0 for this year, 0.3% growth this year in Mexico, pretty bad, with a pickup next year to 0.7% growth. But here, you can see here that for the region, since 2012, we've been in steep deceleration. 2017, we saw an uptick, but we are once again on the downturn. Argentina is in recession. Mexico is avoiding recession, but it certainly feels like one here. And of course, Venezuela is in recession. Chile and Peru will avoid it. And I would say those are the worst performers. In terms of real GDP growth for the year, you can see here, Argentina is definitely the worst. I'll get into, jump in here if you have questions. I'm happy to give you some of the feedback that I got from the IMF meetings 2 weeks ago.
On the Chile numbers, you take in consideration the recent.
No, I have not yet done that. I have to see how the fallout is before I change the forecasts, because I want to see what the government's response is going to be. I suspect there's going to be a lot more social spending. And so if there's more government spending, it could actually be a positive. My concern though is with investment going into the country. That's where Mexico's falling
So
short.
a huge reversal in the investments going to Chile.
Yeah, it's a shame. It's a real shame. The truth is, Chile doesn't even have a very deep capital market, so it's not like you can buy a ton of bonds in Chile. They've got, what, 3 international bonds, 4 international bonds, so it's not a very deep and liquid market as it is. But certainly, if you look at these, this chart, the whole region is growing below potential. So everyone's growing below potential, which means that this chart should not shock you. This is inflation. Look at this chart. Inflation is very, very low in Latin America, remarkably low. Colombia is the only country that is seeing a little bit of inflationary pressure, and it's the only country that hasn't yet cut rates in the entire region. So as I was stating, growth is below potential, which means that inflation is not running amok. Inflation has been remarkably low. What does low inflation mean? Central banks say, thank you very much. We're gonna slash rates. So what have they done? Look at Brazil. Brazil went from 14, it's going down to 5. And I'll bet you it goes down to 4, maybe below 4 by the end of next year. Right now the Selic is at record lows, and it's been at record lows for like the past year. So it's just making new record lows, new record lows. Inflation is going to end the year, I'll bet you it ends the year in a 3 handle. And that's an incredible feat for Brazil. Now, Brazil I'm bullish on, but everyone is. So there's not a lot of juice left to run in Brazil. Okay. Everyone else cutting rates. Fiscal balance, negative. Not a lot of fiscal space. Not a lot of fiscal space. In Latin America, there's still a lot of monetary space. They're not at the zero bound. They're not even close. Mexico's probably going to go lower. They're going to follow the Fed. And Brazil, as I mentioned, is going to continue to take down rates. Colombia is going to take down rates. Everyone is cutting rates. Good for fixed income. I've got to be very candid. Okay, low default rates suggest consumer not yet on the ropes. Love Brazil, markets are very rich. Fixed income, better than equities. Equities are too rich. But you can get PBR, you can get Petrobras for a nice juicy yield. Still looks better versus Pemex. And you can see the consumer is not on the ropes here. Delinquency rates are still very, very low. Look at the outstanding loans, blue. Blue is outstanding loans, left-hand side, you can see in absolute values they're going higher. Personal loan default rate, ticking up slightly, but 5%, pretty insignificant. So, consumer confidence, love this chart. This is the Bolsonaro effect. And I don't know where you stand, but I think the numbers are the numbers. You see this for the US, you saw this right after the 2016 election, same exact thing. You saw the same exact phenomenon happen with consumer confidence as everyone expected lower taxes, less regulation. Period. Same thing with Bolsonaro. The guy wins, the consumer confidence jumps up. Market strategies and investment recommendations, again, I'll send this to you. These are my recommendations. These are my bond picks. I like Brazil local currency. The currency's big time undervalued. I see potential for room to run there. So you can buy the NTNF. I like Petrobras. You can see the Bono. I closed that recommendation. Closed Pemex. But I would be interested in reopening these in the near term. Argentina I got completely wrong. So that's for sure.